Good evening, ladies and gentlemen. I think we're live now. Just give it a couple of moments, see if we have a few more attendees coming this evening. I did see on the list of registrations that we have a few people joining us from Thailand tonight. I think our marketing team have been pretty good in promoting this in different places. So we're going to keep this fairly short. I think we should be able to cover the slides in less than 30 minutes. There will be a Q&A session at the end. You are automatically set to mute. I don't think we've set it up so that you can unmute. I think because we've got quite a large audience tonight, what the marketing team who are running this I've done is put everybody on automatically defaulted to mute. So if you do have any questions, please can you use the chat or the Q&A. I'm going to try and address any questions we've got over the course of this presentation. So I think we'll kick things off now to get off to a nice punctual start. Welcome everybody. My name's James. I'm a financial advisor at the Holborn Assets group. I'm based out of Dubai. I think we've got people attending from Europe. Even I saw one person from Latin America. So good morning to you guys down there. Good afternoon and good evening to everybody else. So I'll just give you a quick brief on the agenda that we're going to cover today. I'll be giving you a short introduction about myself and the company I'm working with. Now, I know that a few of you that are actually attending tonight know me or know my company already. You're already working with us, which is fantastic. But just for those of you who have never heard of us before and have just clicked on the advertisement that we've had on, I think running on Facebook and Instagram and that, we'll give you a brief background of who you're talking to today. Then I'm going to go on just cover some quick facts about the state pension. There are some areas of ambiguity about what exactly it is, so I'll click that. I'll cover that. We're going to talk about then the eligibility requirements, who can get a state pension, and how much the state pension will be, what your entitlement is. It's the word that they use is entitlement. So we'll do that. Then we're going to go on to sort of a step-by-step guide to actually how to check your national insurance contribution record. Then to find out, okay, if there's a shortfall, what years you've missed and how much shortfall you have. And then we're going to be telling you a kind of a sort of a hack, if you like, on how to qualify for the lowest possible contributions, which hopefully if you're working and you're attending as an expat and you're a British national working overseas, you can do. So I'll explain that. And we'll talk about backdating the contributions. Then I'll show you where you can find the form to be able to do this. It's if we're going to do the hack, it's still a manual process, unfortunately. There is a bit of a delay on applications from HMRC side at the moment, so it makes sense to get a head start on it while you can, especially with the the holiday period coming up in December. So that's it. I'm going to crack on to talk about who you're talking to here today. I work with a firm of financial planning consultants. We are based all over the world. We now have 13 offices in 11 countries. We're regulated here in the Middle East. We've got the UAE license. We've got a license in Saudi Arabia, UK FCA regulated license. We have a lot of clients, obviously, in the UK, and we're big in Europe. We've got offices in Spain, Portugal, Cyprus, and those companies are regulated under what is known as a MiFID II license, which allows us to basically give customers financial services advice anywhere in the EU. And then we have offices out in the Far East. For you guys out in Bangkok, there is an office there on the Sukhumvit Road, which I'm sure if you live in Bangkok, you'll know that particular area. So we also have offices in Kuala Lumpur, and I think there's Ho Chi Minh City, and Hong Kong, maybe some other ones over that way. But anyway, we've been around for a long time, and we are actually very proud of having now over 2,000 positive reviews on Trustpilot. So a lot of people are giving us a good recommendation, and hopefully that should say something about the kind of service that we provide. There is a list of the different types of services that we offer down at the bottom here. It's not exhaustive. There are many other things, but I'll introduce myself briefly. I've been working as an expatriate financial advisor for 15 years. I came to the UAE in 2007, and I'm fully qualified under the UK rules through the Chartered Institute of Securities and Investment, the Chartered Insurance Institute, and the Institute of Financial Services. So I've done a lot of the financial services qualifications. My area of specialty, if you like, one thing I really focus on is giving advice to UK expats and international investors on UK tax. So this is about the state pension, but if anyone's got any tax related questions, feel free to drop me a line. I'll be sending you a follow-up email tomorrow with the presentation attached. And if you want to get on a Zoom call or meet me in person in Dubai, you're very welcome to do so. So what is the state pension? Well, the first thing that a lot of people don't actually understand about the state pension, so I'll just sort of address this, is that you are not paying today for your state pension. You're paying, if you like, kind of a tax. If you know, it could be described as a tax or sort of a government initiated wealth transfer type premium that you'll pay, which is paying for other people's state pension who are claiming it today. Okay, so when we talk about the state pension, it's not like you're saving any money here into some scheme which then you will get the benefit from in the future. What you're actually doing is buying yourself years of entitlement. Okay, so for each full year's contribution that you make, you will receive 1 year's worth of entitlement. Okay, the entitlement is index linked with the cost of living increases. There's this triple lock thing that you might have heard about recently in the press. Okay, that it's likely that the contributions will increase in the future to be able to cover this because it's quite a big increase. The triple lock basically is talking about either cost of living increase, cost of labor, or salary increase. Okay. Or the greater of 2.5%. That's obviously going to be more than 2.5% this year round. So it's going to be either the consumer price index, which is linked to inflation, which we know has gone up a lot, or the salary increases over the year, which also is linked to inflation, and we know is also going northwards. So state pension will go up. And it will go up every single year with cost of living increases, or by 2.5% if there's deflation in that year. So it will continue to rise. But at the moment, the state pension today, if you have got the full amount of qualifying years, which we'll talk about in just a moment, will get you a sum of £185.15 per week. So that's today's state pension. Obviously, by the time you retire, whether that's in 10 years, 15 years, 20 years, or whatever it might be, that will increase to reflect the cost of living or increases in the wages, or 2.5% of the greater of. So hopefully that's an explanation. I've not had any questions so far. I'm not sure if I'm going a little bit fast. So if anyone feels that I am doing so, please just raise a hand or something. But I'm trying to keep this concise so that you can get on with your afternoon, evening, or morning if you're down in Mexico. But here we go. So how do you qualify? Well, you need to have, let's take a step back a second, actually. So if you're retiring after 2016, there's new set of rules that were introduced. So assuming you're not already claiming your state pension and you haven't already retired or reached state pension age, then you would need to have at least 10 years of contributions into the state pension or national insurance contributions into the state pension scheme to get anything at all. So nowadays, if you've got less than that, then unfortunately you won't get a state pension, even if you've got 9 years. Now, you know, this affects quite a lot of people that worked in the UK and then left and went overseas. And it also affects a lot of migrant workers. So we in Dubai, we've got a lot of people, especially from India. I'm dealing with many Indians who are working for the NHS in the UK, but now they're working over here. But prior to that, they were in India, and actually they were only in the UK for 5 or 6 years. They've made 5 or 6 years of contributions. Now, unless they top up, they will not be able to get any state pension at all now under this new rule that was introduced. Okay, now the other thing that changed is that the number of years of contributions that you need to make to get the full state pension was increased from 30 years to 35 years. So for you to receive a full state pension in the whole period of your working life, from whenever it was, whether it was, you know, 16 or 15 years old, or, you know, 28, and, you know, when you graduated from your master's degree or whatever it might be. But from that point onwards, you need to make 35 full years of contributions. What if you haven't? Well, you need to backdate and top them up. Okay. Now, how is your state pension entitlement calculated? It's as a pro rata sum of whatever the annual state pension entitlement is today divided by 35 years. So I put an example at the bottom of the screen here, and it's really, really straightforward, but I'll just go through it very briefly. If you've made 20 years contributions over the course of your lifetime, then you will actually have to divide the sum of today's state pension, which is 9,628 by 35 years, should I say, and then multiply it by 20. And that would mean you'd arrive at having a state pension of £5,502 or £105.80 per week. Okay, so whatever number of contributions years you've made, you would divide the state pension in that year. If it's going up to 10,000 next year, it will be 10,000 divided by 35 times the number of years worth of contributions that you made. And that's where you will know what your state pension is today. Obviously not in the future, because it will go up over time. So how do you know what contributions you've missed? I've got a few slides here on how you check the national insurance records. Now, I have talked to a few of you before this webinar tonight, and I understand that you've already done that. So, you know, you can just turn off for a couple of minutes. But for those of you who haven't, the UK government have got this gov.uk unified gateway portal. I think as far as government gateway portals are concerned, it's actually really slick. They've got pretty much everything you need in here. However, they do use a lot of very long and complicated terms, and I think they expect everybody to be an expert and understand everything. So it can be a bit confusing in terms of what their descriptors are on various different qualification criteria or whatever. But the actual process of you getting your record for your national insurance is really, really simple. So if you've already registered with the government gateway, and if you're an expat, you may well have done so, because you need to register for this if you're registering a birth, or if you're renewing your passport, you'll use the government gateway too. I think even renewing, I did it with my driving license too, so I think it's all unified now. But anyway, you'll have this thing called a government gateway ID. Now, if you don't have this, then you need to get one. There is a bit of an issue with this for certain individuals, especially if they've been outside the UK and they don't have any footprint in the UK anymore. And the reason for that is because you need to answer some security questions, and those security questions are randomly generated from information that Government Gateway has on you from when you were living in the UK. So it might be your driving license number, it could be your passport number, but it could also be you know, who your mortgage is with, and they can check your credit file, or what you know, what bill you've got that's a certain amount or something. So these, we don't know what these security questions will be, but generally you've got to answer 3 of them. And we do have some issues with people that have been overseas for a long time. They're not able to answer it, you know, 2 or 1 of those 3, and they can't register for their Government Gateway ID. So if that happens to be you, don't worry. We work with a UK tax advisor that's registered as a proxy with the HMRC, and they can, with your permission, you appoint them, they can just do this process on your behalf. Okay, so you don't need to give up hope there. But that, once you've got your Government Gateway, it's really easy. What you'll do is you'll log in. The link I'll share with you, it's embedded in this presentation, so you can easily do this in maybe tomorrow if you want to go through this. But then what you'll do is you'll log in. You will be able to see your record. This record here, you can see there's 12 full years of contributions, 26 years left to contribute before 2047. So that's that person's retirement age, and 14 years that have not seen enough contributions or no contributions at all. Now, if you were to click on any one of those where it says view details, those little tabs, then it will show you that the year's not full, you did not make contributions, blah, blah, blah. And it says you can pay the voluntary contributions of £824.20 by the 5th of April 2026. It's saying that the shortfall may increase after April 2023, next tax year. That's because obviously the pension contributions may go up and the cost of living increases will go up. The state pension itself, the payout will go up. So this amount will usually increase over time, or will it actually, it should always increase over time. But anyway, please, if you're attending this, the biggest takeaway hopefully is that this is the default option. It's actually the price to buy the class 3 voluntary contributions, which are more expensive than class 2. So what we want to do is ideally play the class 2 contributions, and I'll show you why shortly. I think there's a couple more people just joined. For those of you now who missed the first part of the presentation, don't worry, I'll be sharing this with you tomorrow. Okay, but we were just covering basically what was the state pension, which hopefully you already know, but if you don't, just to give you a bit of background, and how much the entitlement is, and what the criteria are to be eligible, how much you'll get, and what each number of years you need to get the full state pension. So it's 35 years. And also we just then showed you how you can check your missed contributions, which I will put a link you'll find embedded in this presentation, which I will send you tomorrow, which you can just go through to the HMRC website and you can check that. Now, let's talk about why someone should pay their state pension contributions as an expat. Okay, and I just want to illustrate this. I just want to show you what someone would pay if they were paying state pension contributions in the UK. So I've just changed the share now, and you should be looking at a website called the salarycalculator.co.uk. Okay, I'm showing you this because I've been an expat for many years before I heard about this. And when someone mentioned it to me, I was saying, well, why on earth would I want to pay my national insurance contributions when I'm overseas? It doesn't make sense to me. And the reason for that is because I was actually under the impression that my national insurance contributions would be quite a large amount of money, because when I was working in the UK under PAYE, I was actually paying a lot of national insurance, and I didn't really want to pay that. I thought it's much better I just pay that into some sort of investment plan, offshore, tax-free, and then it's my money. I'm not paying for other people's retirement. But what I didn't realize is that when you're eligible for class 2 or class 3 contributions, you don't pay anywhere near what you would pay if you're under PAY system as a UK tax resident. And this is where it's an absolute no-brainer, I believe. So I'm just showing you, and hopefully you can see here, the projected annual breakdown of somebody who earns a gross income in the UK of £50,000 per year. Okay, so where's my, I can't annotate this for some reason. It's not, the option is not here on this presentation, but hopefully you can see where I'm referring to. The top line is the bold, 50,000. Second line, we've got taxable income after the personal allowance. Third line is how much tax that person will pay. And the fourth line is how much national insurance they'd have to pay. And the sum is £4,959 per year. So almost 10% of that person's income is paying for their national insurance contributions. Okay, now remember that sum for a moment. £50,000 a year, it's not a particularly large income in the grand scheme of things, especially today, and especially if you're an expat, it's not a particularly large expat salary. So let's have a look at what people pay if they're overseas. So under class 2, your contributions, you're eligible for class 2 if you're ordinarily employed or self-employed right before you left for the UK, and you have a minimum of 3 years contributions in the UK before you did leave. Okay, and you've got to be currently employed or self-employed overseas. So if you're already retired overseas, or you're living off an investment income or something like that, unfortunately, that would not be class 2. That would come under class 3. Okay, but how much is class 2? It's £3.15 per week. Okay, £3.15 per week. That's £163 something per year, I think. It's on the next slide. We'll come to that in a moment. Okay, which is obviously a damn sight better than nearly £5,000 a year if you were earning £50,000 in the UK. So why should you pay? Well, number one, because you'll never have the opportunity to pay this much for national insurance contributions if you were living in the UK. So you may as well seize the opportunity while you're overseas. Okay. Now, assuming you're not employed or self-employed and you didn't work in the UK before, then you can go for the class 3, which is not quite so good. It's 5 times the price of class 2, but it's still a lot less, 800 and something odd pound a year than you pay if you were UK tax resident under PAYE. Okay. On another note, and I don't know, I've never understood or get my head around this, but class 2 contributions actually have more benefits than class 3, even though they're cheaper. So as a class 2 a contributor, you still get the employment or unemployment, the dole money, we used to call it when I was back there, and you get what was known as incapacity benefit back in the day, which you won't get under class 3, unfortunately. And you also get bereavement benefits if you were to have to stop working due to a bereavement. So I don't know why it's so cheap. There's never been any sort of reasonable justification why it's at this amount. Will it be like this forever? Who knows? I mean, there's obviously a huge deficit the government's going to have to cover. So they're looking to increase national insurance contributions across the board. But I just want to put this into numerical context here. Under class 2, you'd pay £163.80 in contributions per year, and if you were to divide the annual entitlement, assuming you paid the full state pension, by 35, which is the maximum number of years you can contribute, then you will find that each year is worth £275 in today's money. So assuming that you plan to live at least 1 year after the age of 67, which I'm hoping all of you guys do, otherwise probably you wouldn't bother attending tonight, you're going to make your money back in the first year alone, and you'll make that back for every year for the rest of your life, and it's index linked. So although it's £275 today, by the time you retire, that could be £350, £500, even £1,000 if your retirement's 30 odd years down the line. So this is an absolute no-brainer, and we do this for people that are financially set. We also do this for people that have got no intention to ever return to the UK, because you can claim your state pension if you live abroad. And there are certain countries, unfortunately, where once you start claiming, you don't qualify for the cost of living increases. Okay, but there are many countries where they have an agreement with the UK where the cost of living increases will still apply, most countries, in fact, but some countries are excluded. But even if there are no cost of living increases from the date that you've made your first, the first year's withdrawal, you're making your money back. And you're making, a almost unlimited profit, because you're going to get that money recurring for the rest of your life and index linked from now until the actual day that you do retire. So basically, I put it here in bold green writing. It's free money. It's an absolute no-brainer. If you can afford to do it, then there's no other investment that's guaranteed by the British government and will give you this sort of return on investment. So that's it. Now, let's talk about one important aspect here, which is going to change. And it's the reason why, if somebody's thinking about doing this, they should try and get this done as soon as possible. It's because normally you can only backdate for up to 6 years of contributions that you've missed. And I've got many expat clients that have been out of the UK for 20 odd years. So obviously they have no hope in backdating all of their missed contributions by the time they retire. Okay. However, there was a temporary break on this. And in the sort of post-COVID, turmoil that was happening and everything, this 6-year, cap was temporarily lifted. And at the moment, until the next tax year, you can backdate up to 2006. So that actually allows you to backdate for 16 years. So this is for someone who's been out of the UK system for a long time and got a lot of national insurance contributions that they missed. This is once in a lifetime opportunity where for such a small amount of money, you can buy back all your missed contributions and get like bang up to date. And obviously, if you want to continue contributions going forward, you can do, and you just pay whatever they happen to be for each year that you're due in the future. And most expats, they'll do it to pay on an annual basis if you set it up to pay on a bank transfer. So you don't need to worry about having a direct debit for some nominal amount coming out or something. It's just a once a year thing. But I got a quick example here. So let's assume that person we were talking about earlier, they missed 12 years, I think, of contributions. So 12 years at £3.15 per week. That's what it is this year. Unfortunately, you can't pay what it was in previous years when, for the years that you've missed, but at least you can pay what it is today. And so you'd have 12 years contributions at £3.15 per week. I make that £1,965.60 that you'd need to pay to top up and get back to, basically having full contributions to the point where you are today. Now, those 12 years contributions, if you were to fork out that £1,965 today, would give you, in the first year of your retirement, £3,301, which is index linked from now to retirement. So that will go up every single year. So, by the time you actually retire, it might be 5,000 or 6,000 or whatever it might be. So it really is a fantastic opportunity to do this. Now, there is a backlog of about 3 months. And we're approaching the end of the year. So that's why anyone who wants help doing this, I would strongly recommend that you start the process now. It's a very simple process of filling out a simple form. This is the form. The link is embedded here. So if you click this, you will get you'll land on this page, which you should see in just a moment. Social Security abroad, and you'll be able to click this form, the NI 38 form. Now, I won't click this because I'm going to go back to my presentation, and I'll just show you there because I already have the form. But this is a really long form. I don't know how many pages, maybe 30 odd pages, and it's all guidance notes. The only 2 bits that are important are the last 2 pages. And they're called a CF83 form. So forget about the whole NI 38 document. All you're concerned about here is the last 2 pages. You need to complete this and send it into the address which I've highlighted. Okay, so if you want any pointers on how to complete it, let me know. If you want someone to take care of this for you because you just haven't, you haven't got the time on your plate or whatever, I work with this tax advisor firm in the UK that you can just pay them a fee, and it's just a set fee, and they'll do the whole thing for you. And then once you've actually registered this, you'll get sort of a kind of a statement for information RC, and you'll be able to then go ahead and settle any arrears that you've missed, any missed years contributions, and also set up to pay future contributions going forward. All right, so that's it, guys. I think let's have a look how we did. 2 minutes over. Okay, so I haven't answered any questions yet. There was a question about claiming the state pension when you are retiring abroad. I hope I've covered that, but if you want to, Patrick, like what we'll do, I need to know where you're retiring, because then I can tell you if you'll get the cost of living increases under the Social Security Treaty or not. But definitely you will be able to get the state pension at retirement age, at whatever it is at that date. The only thing in question is the cost of living increases. How do you actually claim? Well, again, on the same site that we're looking at here, we will there's basically a link to be able to go ahead and actually claim the state pension while you're overseas. Now, obviously, most people, if they're overseas, they have a foreign currency bank account. So what they probably do is either use a UK account and get the money paid in there and then transfer it across, or they'll take the payment every year or every quarter or something like that. Not okay. So hopefully that makes sense. So I've got a question from Adam. Hi, Adam. Welcome back. I spoke to you the other day. Thank you for joining. So Adam's question is, what happens if he's currently paying the Class 3 contributions? Can he backdate and pay the Class 2 contributions for the years he'd missed? I believe the answer is yes. I don't think there's anything to stop you doing that. So you just need to complete the new form, do it manually, tick the box to do the Class 2 contributions and backdate with Class 2. Now, I know Adam is someone I'm talking to about a planned retirement. So after you do retire, even if you're not at state pension age, you'll no longer be eligible to pay Class 2 contributions. It would only be while you're employed or self-employed as an expat. So once you retire, if say you're retiring and you're 60, not 66, or 67 if you're retiring after 2026, then you will have to go back to paying Class 3 if you want to continue with any contributions. But I think for now, we need to get you, Adam, set up on paying the Class 2 contributions. And I'll share this presentation with you and also the link to the form. And we're going to have a call anyway, or a meeting and discuss some things. So I'll discuss this with you. Okay, there's a question about whether the contributions will go up in the future. Yes, they will go up. The contributions go up, as well as the benefit of the state pension. So, for instance, last year the state pension class 2 contributions were £3.5. This year they've gone up to £3.15. Next year they will go up again. They will continue to go up every single year. That will be with either the cost of living increases or cost of labor increases, or 2.5%, whichever is the greater amount that the government, used to base their calculation on. Okay. Now I have another question here from Caroline, who's not got an address in the UK. She's asking if she can use her sister's address for the paperwork. Yes, no problem. You can use a UK address when you're doing the application, this application that I just showed you a moment ago, the CF83. You can put a UK address on there. It can be anyone's address. However, you can't go on the government.uk website without doing the security check. So if you've already managed to get your government gateway and you've got your ID, and you can log in and check your pension status, how many contributions you've made or how many you still owe, then you will need probably a UK address of some description that the HMRC can identify you as being living at in the past, either from the voters roll or a credit reference company or something like that. Okay, that's the only thing there. But Caroline, no problem using a proxy in the UK. And in fact, if someone wants to use the service where we can help them with the application from the UK, from this firm that we're working with, then they'll do exactly that. They'll put that firm's address down and that firm's contact person, and HMRC will write to them, and then they will share the information with you electronically wherever you are in the world. So Mike's asking, if they start now, is there a possibility that you might miss the deadline? In all fairness, yes, this is probably the last webinar I'm going to do this year on this, and I've done several over the past, I don't know, 6 months or so. But I think it's kind of now or never, because with the Christmas period coming up, there'll be a shutdown over Christmas and New Year, plus there's already a backlog at HMRC. It might mean that people just aren't able to get in there in time if they start perhaps in January or February before the tax year kicks in. Now, that's not necessarily the end of the world. I mean, obviously anyone can pay class 2 or class 3 contributions going forward, but it would be a big loss for somebody who wanted to backdate a large number of years, more than 6 years, basically, because the cap will go back, the 6-year cap. Okay. Right. I mean, before we wrap up, there's just some tools that I wanted to show you here. So I've embedded in this presentation a cost of living calculator, and it's really detailed. It will probably take you about 15 minutes or so to complete. I think it's very, very thorough. I do this kind of exercise all the time with my clients, and when I filled this out myself, the objective is to sort of calculate in your own, what you predict your cost of living to be when you retire in the future in today's money. Okay, so I plugged in the numbers, and because there are so many things involved in this calculator, like annual holidays and broken down, and replacing the car, redecorating the house, all these type of things that quite often are missed or neglected. Even gifts are in there, and charitable donations and that sort of thing. My actual annual living costs were about £8,000 a year more than I'd actually estimated. So it's a really useful tool. I would urge you to use it. There's also a retirement calculator where you can calculate, okay, now you know your cost of living. You can put what your cost of living is. You can put when you're likely to retire in the future. You can project, an estimated inflation. rate, and then you can see, okay, well, how much would that need to be in the future for you to retire on XYZ income? And then it tells you based on what assets and what savings you've got of things, whether you're ahead or behind in terms of your retirement, let's say, roadmap. So that's also a very useful tool. And that's pretty much it. Okay. We do retirement planning. It's something that a lot of people are not fully prepared for. So we help with that. Myself, especially, I deal with repatriation. It's a big issue. A lot of people are repatriating or they're expats from the UK that they might not be repatriating. They might be moving back to Spain or something in the future, but they still have UK assets and UK income from those assets. So there are certain tax implications. So again, these are things that I can assist you with. And even if I can't assist, my team, we have a huge team of specialists at Holborn. We've got everything from mortgage advisors, currency traders, lawyers, CPAs, and chartered accountants, chartered tax accountant advisors, should I say, all working with us to help our clients. So if there's anything you need, let us know. But otherwise, I don't see any more questions. So I will wrap up now, unless there's anything else. Okay, so I'm happy because I think most of the people that had joined at the beginning are still here. So good night or good afternoon or good morning wherever you are, and have a great day tomorrow. And tomorrow you'll get this information from me, and I will ask my assistant to follow up with you if we're not in contact already, and if we are in contact with already, I'll be in touch with you in person to see if there's anything I can assist you with. So I'm going to stop the share now. Thank you very much. Have a wonderful evening, and I'll let you get on with the rest of your day. Thank you. Bye-bye. Bye.